In a functioning market, this chart is impossible. It violates the laws of physics in finance, but as of December 2025, the one-year silver swap minus the US interest rate has hit negative 7.18%. Welcome back and listen closely. The mainstream media is telling you silver is rallying because of inflation or geopolitics, but they are not telling you the whole story. We're witnessing a super backwardation. Usually buying silver for future delivery is cheaper than buying it now, because you don't pay for storage and other related fees. But as of today, physical silver is nearly 7% more expensive than future promises. Why? Because the vaults in London are running on fumes. There is a specific liquidity mechanism, a drain in the US banking system that is forcing this metal to move. And it all comes down to a number, $2.8 trillion. Let's look at the plumbing. For the last 2 years, the Fed's reverse repo facility, the spare tire of liquidity, was draining to keep markets afloat. That tire is now flat, the RRP is at zero. Now the liquidity drain hitting the engine block are bank reserves. We are currently at 2.879 trillion in reserves. This is the danger zone. When reserves drop this low, banks hoard collateral. They stop lending. The repo rate spikes, cash is scarce. Here is the connection. In a liquidity crisis, cash is king, but true collateral is emperor. London holds unallocated silver, essentially paper IOUs. Shanghai holds warrants for physical metal. The spread between Shanghai and COMEX also has blown out. Traders are draining the London vaults, taking the physical bars and shipping them fast to capture that premium. This isn't a trade. It is a bank run on physical metal. Now, the skeptics and the major banks will tell you this is normal. They argue that high interest rates usually crush non-yielding assets like silver. And historically, they are right. If you can get 5% in a bond, why hold something that doesn't yield anything? But that logic fails when the physical asset is missing. Look at the lease rates. If you want to borrow silver today, you pay a premium. That implies a shortage. However, a warning, we must be very careful. While the shortage is real, parabolic moves attract dangerous leverage. If an entity is trying to corner this market, exchanges will change the rules. They will raise margin requirements, they will force liquidation-only trading, and if you are leveraged 100x on silver futures, a $2 pullback will wipe you out before the rally continues. So what does this mean for you as an investor? This negative swap rate is the canary in the coal mine for counterparty risk. The system is telling us that a promise to pay is no longer worth the same as the payment itself. As bank reserves grind below $2.8 trillion, expect your mortgage rates to become volatile. Not because of the Fed, but because the plumbing is clogged. The banks are fighting for cash. Meanwhile, the wealth transfer accelerates. The West is selling paper claims, and the East is stacking kilobars. The SG warrants prove the inventory is moving there and staying there. So we return to the red line. Only when the line returns to positive, supply and demand normalize. So we are currently diverging away from normalization. The London silver market is devolving. We are watching the repricing of trust in real time. Until US resolves its liquidity crisis and bank reserves stabilize above 3 trillion, the physical squeeze is the only game in town. Don't chase the paper price, watch the swap rate. If it stays negative, the rally isn't over, it's just finding its true floor. The mainstream financial networks will only report on this after the vault is empty, so we are tracking the liquidity drain every single day. If you want to be on the right side of this wealth transfer, you need to see the next signal. Hit the subscribe button and turn on notifications now. I'll see you in the next update when we check the reserves again.